Welcome Laura Foll.
Thanks very much, Mark, and hopefully everyone can see and hear me. Perhaps that's great. Thanks, Pavlina. If we flick to slide 2, I wanted to just start with a bit of history of Lowland that looked like roughly half of you knew it and half of you didn't. So apologies if I'm telling you what you already know to the half that do know it. But just a bit of history. If you go over the very long run for Lowland normally has, you can see here, roughly a third weighting in smaller companies, a third in medium-sized companies, and a third in larger companies. So compared to our UK equity income peers, compared to other UK equity income trusts, we are historically more weighted to UK small and medium-sized companies. I just wanted to briefly cover why. Why do we think it's worth having exposure to that smaller company area? These companies historically have grown faster. They're at an earlier stage of their life cycle on average, so they have a longer pathway of growth ahead of them. They can grow on average sales faster, earnings faster, and ultimately dividends faster. And we'll talk more detail about dividends, but over the very long term, Lowland used to, when I think back to when I was doing this sort of 10 years ago, Lowland used to often be at the top of the AIC income growth tables. It would grow its dividend faster. It wasn't always necessarily the highest yield, but it would grow its dividend faster. And we were able to do that because of the small and medium-sized company weighting. And so COVID sort of kiboshed that a bit, and we'll talk about that. But that was always the historic, if I'd go and sit in front of a client, I'd say, look, the dividend is this, but we expect it to grow at a decent clip. Now, you can see from the chart on the left that at the moment, so Lowland is the orange on the chart on the left, we have more like 50% just under in the FTSE 100. So we are more heavily weighted in larger companies than we have been over the very long term. So it's worth just covering why. I think the first thing to say is that has helped our performance, having that higher than normal weight in larger companies. The market has been challenging, particularly after the Ukraine war. It was really the more defensive, larger global businesses that did well in that very difficult backdrop in 2022 when we saw commodity prices spiking, etc. It was really the BPs and Shells of the world, the commodity producers like Anglos that did well in that type of environment. So having that additional larger company weighting has helped. But, and this is the most important part, and this is what we're trying to get at with the green arrow, if anything, we think the smaller end of the market is the area where sentiment is definitely weakest in the wider equity market. For that reason, valuations are lowest, and I can show you some charts on that. And so the direction of travel for me and James, who I run the portfolio with, is to move down in the market cap scale towards the 250, so medium-sized companies and below. And actually, this data is struck as at the end of October. If you struck it closer to today, that FTSE 100 weight would already be more like 42%. So we are moving down towards those smaller and medium-sized companies. If we flick on a slide, just wanted to briefly cover, we very recently held our AGM. Our financial year end was the end of September. So I won't spend too long on this because I know the end of September is quite a long time ago now. But if we just briefly talk about the results, the NAV was up 17, that compares to the market up more like 14. So it was outperformance, but I would say it was modest. The dividend was put up, again, a modest amount, 2.5% to 6.25p. As at today's price, that's roughly 5.4–5.5% yield on today's numbers. And importantly, that was covered by earnings. So earnings were 6.7p compared to 6.25p. So we're back putting money into the revenue reserve, having drawn down on it pretty steeply during the COVID years. And then finally, because the end of September is quite a long time ago now, if you look at the period October, November, December, the NAV for this trust was up roughly 5 compared to the benchmark up 3. So there was a further modest outperformance in the final few months of the last calendar year. So if we flick on and sort of try and drill down into what is it that's driven recent performance, just sort of dynamic beneath that. If you look at the table on the right, and I'm really looking here at the final column of that table that's called index total return. This is nothing to do with us. This is literally just what did the index do in the last financial year. So the FTSE 100 returned, I'm rounding a bit, the FTSE 100 returned about 15. in that year. So the larger companies returned 15, medium-sized companies, the FTSE 250 was 10, small cap 7.5, AIM minus 8.3. So there was a huge difference between how the larger companies did last year and the smaller companies did, over 20% difference. Despite that headwind, Lowland outperformed, and there's a very specific reason why, and it was largely takeovers. And I'm not exaggerating, we had roughly a takeover every 2 months for this portfolio last year. This calendar year, we have already had 2. So in this particular financial year, we had K3 Capital, which is a corporate services business. Numis, I'm sure familiar to many of you, got taken over by Deutsche Bank. Devro, which was sausage casings, got taken over by a European peer. This calendar year, we've had Wincanton be bid for by a French peer, cash offer at 50% premium. And we've had Elementis, which is a specialty chemicals company, turned down a bid from private equity. I'm spelling all this out because I think private equity are looking for something. Of all the portfolios that me and James managed, Lowland has had by far the most takeover offers. And I think it's because PE and to an extent other European international peers are looking for something very specific. And it's an acquisition that's de-risked. So if you think about Lowland, it's got a smaller company remit and it's got an income objective. And that leads us to a very specific type of cash generative, often market leading UK business. And when I say market leading, I'm talking market leader in often quite a small niche area. So Devro was the market leader in sausage casings. K3 Capital was the market leader actually in corporate advice for smaller companies. These aren't, I'm not talking Microsoft, but these are smaller businesses. They have their niches, they're market leading, they're often run by management teams that have been around for a long time, very conservative, often good balance sheets. So if you're private equity and you're looking to do an acquisition, or your peer and you're looking to do an acquisition, the Lowland type of business is screening as a relatively low risk acquisition. And I think that's why we're seeing the degree of takeovers that we are seeing. And like I said, more so than in other portfolios we manage that are larger or sometimes smaller. In the case of Henderson Opportunities Trust, it is that more de-risked takeover. So that's one element of what drove the performance, and I think the strongest element of that performance last year. And then the other one, there are companies in the UK that have a strong degree of self-help to them. I think the one that's most well known, obviously it's a household name, would be M&S. We hold that in this portfolio. That has obviously had many attempts at a recovery, and last year it looks like they might finally have the successful elements of a recovery. To be completely clear, we have not held M&S. This is not a position that we've held for 10 years. We bought M&S a couple of years ago when Archie Norman, who's still the chairman, became the chairman. But in a new management team, took some really difficult decisions in terms of closing quite a lot of stores, bringing down prices quite a long way, making it more competitive. And it seems that those are paying off. They're back winning market share in both of their categories, so food and clothing. And they seem to have so far got themselves into a bit of a virtuous circle where they take market share, they upgrade earnings, they can make prices more competitive, they take market share. And so that's what drove the performance last year. But I'm aware that 1 year is not a very long time period, in an investment horizon. So if we flick on to the next page, this is the longer term performance, and this is to our financial year end, so to the end of September. And what I wanted to cover really was the 3 and 5 year, because the 3-year number looks nice and the 5-year number much less so. So I think both of those numbers need explaining. So the NAV on a 3-year basis, you can see here was up roughly 50, the market was up about 40. What you find with performance numbers is that your starting point makes a huge difference to your ultimate performance. If we think about where a 3-year number starts from, it effectively starts from the very strong bounce that we got when Pfizer came out in, I think it was beginning of November 2020, and said, we've got a vaccine. And that was a really strong period for Lowland, because Lowland, it does have more exposure to the underlying economy, in our case, the domestic economy, than a lot of our peers. If you drill down into Lowland, we would have roughly 50% of sales for the whole portfolio here in the UK. The benchmark, the FTSE All-Share, would be more like 25. So you could think of Lowland as having a roughly 25% overweight, bigger weight in the domestic economy. So when Pfizer comes out and says that we've got a vaccine, and suddenly people think, right, well, COVID might actually come to an end, bars and restaurants can open up again, it has much more of an impact for the Lowland portfolio that does have that more domestic cyclical tilt than it does for some of our peers that are much more international. So that's what drove the 3-year performance. The 5-year performance, on the other hand, looks much more challenging. 2-3% NAV growth, the market up more like 20. So substantial underperformance over that 5-year horizon. And it comes down ultimately to the same reason, in that domestic business is exactly the type of business that following Brexit really derated. And again, we'll show you a chart that shows the point at which domestic earners do this and international earners do this in terms of performance. And we can debate Brexit, but it's very clear the point at which the domestic derating starts, and it's the middle of 2016. And that was much more material for the Lowland portfolio and the rating on the Lowland portfolio than many of our larger cap, more international peer group. So if we flick on, I won't talk too much about discrete year performance. I think the thing that stands out to me in this table is that you can see the NAV returns in that very strong year during just following the COVID bounce, so September 20 to September 21. I think what discrete year performance always shows me is that performance is never linear. And just the importance of, if you'd missed that COVID year, that 50% year, your returns would look completely different than if you'd been invested the whole time. To me, all of these discrete year tables, what they show is the importance of staying in the market and not trying to time the market, because if you'd missed that one year, your returns would look much, much, much worse. If we flick on to dividends, I know that for a lot of people, the dividends are of prime importance. So we try and make them really predictable. So Lowland pays a quarterly dividend. We have what we call a progressive quarterly dividend policy. And what I mean by that is that, barring very unforeseen circumstances, that each quarterly dividend will be at least equal to the last one. So just give an example, the current quarterly dividend run rate is 1.6p. So you would expect each quarterly dividend from now on to be at least that, and ideally, go up modestly from there. At the moment, the dividend is 6.25p. As I mentioned, that's roughly a 5.5% yield at the moment. You can very clearly see on this chart when COVID hits. So the dividend had been growing at sort of 7-8% roughly per year. COVID hits and the dividend essentially flatlines with no, very, very modest dividend growth levels. What effectively has happened is that dividends during COVID fell roughly 50%. We kept the dividend flat to slightly up. We have been growing into that dividend ever since COVID happened. And then right at the beginning, I mentioned that the earnings per share in the last financial year were 6.7p compared to the 6.25p dividend. So we've effectively gone through that period now of growing back into the dividend, and we're now back putting a decent amount into the revenue reserve. The board are trying to signal the last two quarterly dividends have been put up 5% year on year. What the board is trying to signal with that is that very challenging period where we're growing back into the dividend we're already paying has effectively come to an end, given that the dividend is now well covered again. So over this very long time period, the Lowland dividend has grown at a roughly 6.5% CAGR. Over this 30-year period. We've gone through the COVID period now of, let's face it, disappointing dividend growth, and I'm hopeful that we can now come back out the other side of that. Obviously, you never quite know what's coming your way, not just dividends, but that's based on what we're seeing now. Barring anything unforeseen, that's what I would expect. And I'm happy to take more questions on dividends at the end. If we flick on to valuation, there are effectively two ways you could view the valuation of this trust, and effectively two discounts, if you want to see it like that. The first is at the trust level. When I was writing this presentation, the discount was about 8.5. this is the discount, the share price discount to NAV. At the moment, it's actually wider than that. It's more like 11 to 12% today. The whole of the UK equity income sector has suffered a bit of a derating in recent months. So the last time I looked, the whole of the UK income sector was on about a 5% discount. So not super unusual in having seen that discount widen, but that is contributing to the yields on the trust being 5.5, which would certainly be comfortably above its long run average. So that's the first discount, if you like, at the trust level. The second layer of that is that the portfolio itself is at a big valuation discount to its history. We've put this here. These numbers are as at the end of December, by the way. The 12-month historic PE is below 9, whereas if you went back over the last 10 years, the average would be 13. So the trust itself is at a bigger discount, say 5% bigger than normal, a bit more. The portfolio is at an over 30% discount to where it has been historically. So I guess the obvious question is why? Why is it that the whole portfolio is trading on 9 times historic earnings? And I think it's really important that it's historic earnings. So you can't have the debate of, well, that earnings number is wrong and there's going to be a profit warning, etc. This is historic earnings, and you're trading on 9 times. There's, so why? I mean, I think there's 2 elements to it. The first is there is a definite skepticism about the broader economy. People thought 2023 was going to be a recession year for the UK. It ended up not quite being a recession year, but certainly not a stellar year in terms of economic growth. We're probably talking, 0.5% real GDP growth. Until very recently, real wages have been in decline. There has been a definite skepticism towards earnings at the more cyclical end of the market. So that's the first sort of question mark, if you like, over that 9 times earnings number. And then the second point, which has been pretty stubborn, is that there is definitely weak sentiment towards the UK equity market as a whole, and active funds within UK equities have seen, not modest, severe outflows in the years since Brexit, and every fund manager in the industry, in the UK fund management industry, has been grappling with that. So there's an economy aspect to it, and I think there's also a UK equity sentiment aspect to it. So if we address both of those, the economy has performed better than people thought it would at the end of 2022. When for context, I was away on maternity leave for 6 months between about January and July last year, and when I left, people thought the UK was going to be in decent recession. When I came back, the sentiment had changed and got a bit and eased a bit, and actually it looked like the economy was being more resilient than people thought. So I think if we get to the point where it looks like interest rates are at their peak, I don't know what pace they'll come down, but I think it's fairly established now that they're at their peak. Real wages are back in growth. We've got inflation coming down. I think I can see a situation where people feel a bit more relaxed about the UK economic backdrop. I think UK equity market as a whole sentiment seems quite stubborn, and it might need some sort of policy kickstart to sort of get interest back in the UK equity market, and we'll have to wait and see on that. But certainly you're starting from a very modest portfolio valuation, certainly one that in my view discounts a fair degree of bad news based on where it is relative to history. If we flick on to talk about some stock specifics, what are we actually doing? Where are we finding opportunities? I mean, from a starting point, going right back to that beginning chart that I had of the FTSE 100, 250, etc. Most of the companies that we're finding and buying for this fund are at the smaller end, at the more domestic end, because that is where we see the clearest value opportunity. You can see that on the top wiggly chart on the right, the orange line, being domestic earners and the black line being international earners. You can see June 2016, domestic earners suddenly derate and don't come back, and international earners perform markedly better. And the difference now is roughly 30%, a bit more than 30%. That is a big difference in total return between those 2 different subsets of companies. And the domestic earners haven't, and of course there are one-offs, but domestic earners on the whole haven't been hugely operationally disappointing. It has been a derating rather than a series of earnings disappointments that has driven that 30 to 40% total return gap. So what are we doing in terms of stock specific? So I've put a couple of examples here. We are adding to some domestic property companies, something like Shaftsbury, which owns a load of property over in the West End, Workspace, which is short lease office space largely around London and the Southeast. It's a bit of a WeWork equivalent, but not with the funding model of WeWork, to be clear. It's just a REIT in structure, but it's slightly sort of trendy, creative office space. But both of those companies are trading at an over 30% discount to their NAV, and both with really good quality assets in there, we think. We've also taken part in some fundraising opportunities. There have been some companies that have run into balance sheet issues towards the end of last year that we didn't own already, but we actually knew them we had owned them at previous points over the last couple of years. XP Power in power converters, the semis end market had a difficult time, but we think it will come back. So we took part in that for fundraising. And then Videndum is equipment that often goes into the production industry, so film, TV, and because of the actors and writers strikes, they had a bit of a pause on their earnings. So again, they need to raise money. We participated in that. And then we did add to the Wincanton. I sort of debated taking this out of the presentation because obviously it's irrelevant now, but we did add to the Wincanton a fair bit prior to the takeover offer. To be clear, we no longer own it. So anyway, that's slightly irrelevant now, but we were adding to the Wincanton. So if we flick on to the portfolio itself, and I'm not going to go through each of the top 20, I could be here a while. I'm very happy to take questions on any of them. But I think what sort of stands out to me is that there are some holdings in here that are definitely common to the majority of UK income funds. So you'd be hard pressed to find an income fund that didn't own the Shells of the world, the HSBC, Glaxos, etc. But there are also some much smaller, medium-sized companies in here that are more differentiated. So let's give a few examples. Something like Serica Energy is a North Sea oil and gas producer. It's got a very strong balance sheet, pays roughly 10% dividend yield. I think we're more likely to be able to add value in something like Serica than we are in a juggernaut like Shell, where it's very difficult to add value. There's probably 30 analysts or something covering Shell. Something like Morgan Advanced Materials, you can see in there, that's one of our bigger industrial holdings. It's a specialist materials company that serves the likes of semis, healthcare end markets. M&S there, although that's now back in the FTSE 100. FBD, which is an Irish insurer, serves mostly agricultural end markets. So you can see there that it's a blend of the larger companies that are much more well-known, household names, and some smaller and medium-sized companies. And then just a word on the sector weightings. You can see there we do have, going back to that more domestic, more cyclical bias, the two biggest sector positions are financials and industrials. So Lowland tends to do well as a trust and as a portfolio when sentiment towards the domestic economy is improving and the domestic economy is humming along. What has held Lowland back in recent years has been that derating of those more domestic businesses and, I would say, volatile sentiment towards the domestic economy. We have had our moments in the last 6-7 years, but there hasn't been a period of steady economic recovery. We were sort of going into one post-COVID, and then the Ukraine war happened and sort of took the momentum away. But when Lowland does well is when the domestic economy is recovering and sentiment is recovering, and it is really that financials and industrials sector weighting that drives that. And then finally, if we flip to slide 11, the summary. So we've got the discount at both levels. Like I was sort of saying, we've got the weak sentiment, meaning both the portfolio itself is on a discount, so that 9 times historic earnings number, and then the trust itself at a roughly 11-12% discount when it would normally be more like 5. So there's effectively 2 layers of discount there. The dividend is certainly in a more comfortable place than it has been for a couple of years post-COVID. It's back to being covered by earnings, and those last 2 quarterly dividends are up roughly 5%. And then finally, just a word, I think it's sort of been covered, but where we see the best value is those smaller, more domestic businesses, and it's really within a trust structure that you're best able to take advantage of some of those smaller companies because they are quite illiquid, a lot of them. And it would be challenging to hold those types of businesses in an open-ended fund. So I think a trust structure like this is well placed to take advantage of that. So I'll stop there. I can see we've got a couple of questions.
Thanks very much, Laura. Very interesting presentation, and congratulations on outperforming your benchmark. Never an easy thing to do. Excellent. So as you say, we've got some questions. Let's just have a look at those. Can I just remind everyone, if you'd like to ask any more questions, just click the Q&A button at the bottom and you can type them in there. So at the top of our list, we've got a question from Gordon. What do you see as catalysts for an overall re-rating of the UK equity income sector? Private equity and foreign companies obviously see value given recent M&A activity. What's needed for domestic investors to see that value exists?
Very good question. Probably
Not an easy one to answer.
my most asked question, I'd say. And yeah, I find it a difficult one to answer because we can see the value. It is a difficult one to answer because we, as in me and James, can see the value. And to be frank, we've seen the value for quite a while. So the fair criticism of us would be, well, come on, you said the domestic market was cheap, 2 years ago. I've heard this before. So we've seen the value for a while. But okay, so if I were to have a guess at what might improve sentiment or drive some interest, I think you're completely right with takeovers. And there doesn't seem to be any let up in the pace of that. That seems to be the catalyst at the moment, which is a bit of a frustrating one because those companies are going and there's nothing coming in the other side via IPOs at all. So the market as a whole is shrinking. It feels nice on the day you get to take over offer, great, but yeah, the whole market is shrinking. I mean, what else could move sentiment? I think it seems like the Treasury are looking at the area again, having not done anything in the autumn statement of note. We got quite hopeful about the idea of, say, a Brit ISA towards the autumn, and then nothing happened. I think they are looking at that type of area again to encourage domestic investment in UK equities. So that might be one catalyst. I also think just getting through. If we can get to a point where rates are coming down, whenever it is, whether it's May, whether it's August, I think the minutiae of which meeting it is doesn't really matter too much. But if you can get to a point where people feel, okay, well, rates are coming down, consumers are seeing decent wage growth, they've got their energy bills coming down. I think if people can feel that 9 times earnings number isn't on an earnings base that's about to fall off a cliff because the economy feels like it's doing better, I think people would feel more comfortable looking at some of these domestic, more cyclical businesses if they feel more comfortable with the economic backdrop. So that's not a kind of, it's not going to happen in one day. That's more of a gradual catalyst over the next, say, 6 to 12 months. But I can see that if the economy did, feel more comfortable, that would, in my view, drive people to look at that more sort of cyclical end of the UK market.
Yeah, and as you say, when interest rates start coming down, then holding cash begins to look a little less attractive and people might be more inclined to invest it instead. Yeah,
I mean, there's already a little element of that in that when I met people last year, there was often I can go in and I can get 1% or 5% or more on my Hargreaves Active Savings, whatever it is. And it's now, it's more difficult to get that. So a 5.5% yield suddenly looks a bit more interesting if you can only get, say, 4 on a 1 year fixed.
Exactly. Yeah. Right. Thank you. So next we have a question from Roy, who says, I'm very interested in Shaftsbury and pleased to see you buying. Are you happy with the new setup and board since the merger?
Oh, this is one where, so James bought Shaftsbury and I don't know is the answer. Let's be totally upfront. I don't know the new structure of the board since the merger. So James bought it on the view that these are really good quality assets over in the West End, where the 30% plus discount does not reflect the quality of these assets. You can literally go and walk around the West End and see that it's completely buzzing and that rental growth is better. But I want to be really upfront if I don't know the answer, and I don't have that degree of granular detail. I'm sorry, Roy, and please leave the question with us. And when James is back, he's currently in San Francisco. When James is back, I can put that question to him.
I think we'll be able to send you a list of all the questions afterwards, Laura, so you can you can pick up on that afterwards. And I'm sure Roy would be grateful if you can provide an answer in due course. Thank you. Okay. Right. Next, we have a question from David. There's a lot of negative sentiment towards offices at the moment. How do you rationalise the investment in Workspace, and how and why do you see it benefiting the trust?
I think that's a really fair question. I think so. What kind of gives me confidence in it? If you look at the Workspace recent results, they're still getting a really good number of inquiries. So I think it's a very fair question. And with someone that doesn't necessarily works in an office, not lives in the office, works in an office where people don't necessarily come in every day, I understand the sentiment of the question. I think what gives me some comfort on Workspace is that actually it's not really for people like me, the offices. It's for a different type of worker. They're often serving creative industries where you definitely need to come in because your big piece of kit is in the office. So you still need to go to that trendy sort of work. It looks like a WeWork office. It's not. It's a Workspace office down the road to get your big piece of creative kit. And that's why the occupancy level still looks decent, and they're still getting a good number of inquiries, because you would think that they would be right at the forefront of, if the economic backdrop wasn't as good as people thought. These are short leases, 2 years-ish. You can get out of them quickly, but they don't seem to, the occupancy level is just below 90, I think last time they reported. They're still getting good occupancy, but the discount to NAV, I think, reflects a sentiment of, right, these guys are right at the forefront of any economic weakness, and so it will take time for that to sort of correct. But I think the assets will prove to be more. This is just my view, but I think they'll prove to be more resilient than is reflected in that valuation at the moment.
Thank you. Good. Okay, and then we have a question from Bob. Do you think that BAE Systems will continue the performance going forward? I mean, obviously defence is quite a hot topic at the moment, and there's plenty of demand for the stuff they manufacture.
So BAE we sold it towards the end of last year. It was a good performer for the trust. I didn't really think I'd see the day that BAE, last time I looked, it was on 19 times earnings. I can pull it up. It's a rating that's comfortably above where it's been historically. And I'm not saying that's not justified. Obviously, the defence spending backdrop is completely different. So yeah, 19 times FY23 earnings today. So I didn't really think I'd see BAE on that type of model. What we've rotated it into Babcock, which is a different defence company. BAE is much more international. Babcock tends to most of its earnings come from the UK, whereas BAE obviously has a big US component to it. Babcock is more marine exposed and more exposed to the UK. But Babcock is trading on closer to 10 times earnings compared to the 19. So we felt that there was a better value opportunity in Babcock. So it wasn't so much that BAE have delivered very well operationally. Their sentiment has completely changed. I think actually he's not new anymore. The chief exec has done a good job and really improved their operational delivery. But we felt there was better value in Babcock. I think the defence, but I do think the defence spending backdrop is very different now, and I don't think we're going back to where we were pre-Ukraine. So I do definitely want us to have some defence exposure in the portfolio as a whole. We've just slightly switched the company weighting.
Then we've got a question coming from Satish. Given the net zero target and sentiment against fossil fuel investment, is it a good idea to invest both in BP and Shell?
Yeah, very fair question. We have been, just for full disclosure, we have been reducing. So the position in Shell has gone down a fair way. And even though it looks, so on slide 10, we've got the weights there, it looks a good chunk that we've got in Shell and BP, but we are actually quite underweight versus the benchmark weighting. So Shell would be roughly, in rounding a bit, roughly 7% weight of the benchmark. We've got roughly 3. BP, I think, is slightly less than Shell. But anyway, we are underweight both of those names, and we have been reducing. Why do we hold them when the world is clearly slowly moving away from fossil fuels? I think that industrials weight, we've got 28% of the portfolio, almost 30% of them in the industrial sector. Those are big consumers of fossil fuels. So there's an element of having that fossil fuels weighting to say, if we had another Ukraine situation, which no one was predicting that, but it happened, and you got the big spike in commodity prices. If you had that happen again, those industrials that we hold that are big consumers of energy, we need to have something on the other side of it for if that Ukraine type situation, really, obviously,
So
really
it's a
hope
bit of a
doesn't happen.
natural hedge.
Exactly. I can't see us have, for as long as we've got that industrials weight, I can't see us having nothing in fossil fuels, because there just has to be that offset element in it. I don't have it, to be completely upfront, I don't have a strong view on Shell and BP. I think to have a strong angle on Shell and BP is very difficult. They're such, it sounds, they really are an oil tanker. It's very difficult to know in any minutiae. They always seem to disappoint in some way or another on earnings. It's very difficult, but it's, Shell does well, BP does well, and they tend to reverse each quarter from as much as I can see as an outsider. But it is, we do have that industrials overweight, and I think it's right that we have a bit of a hedge, and it did help a lot in 2022 that we had that fossil fuel weighting.
Yeah, absolutely. It makes a lot of sense. Just coming back to the Babcock versus BAE issue, you mentioned that Babcock is on a much lower PE rating than BAE. How do their dividend yields compare?
Very good question. Babcock doesn't pay a dividend yield at the moment.
Okay.
So Babcock is one of these companies where, a bit like M&S, so M&S, I know a lot of people follow M&S very closely. M&S has only just returned to paying a dividend, and it's a very miserly 1 penny. Babcock has been on a very similar trajectory to M&S, where it's been going through a recovery under a new management team. They've been delevering the balance sheet, just like M&S. I know it sounds weird to compare the two, but they are on a sort of similar trajectory.
Yeah.
So both of them took the dividend to zero. Babcock sold off a lot of assets. They've brought debt down a long way. The management is signaling that they are soon to return to paying a dividend, but at the moment they pay nothing. Whereas BAE, I think, is something like a 2.5. It's not a huge yield, but I think it's like a 2.5 or 3% yield. So you are definitely taking a step down in terms of dividend by going to Babcock, where the yield is pretty much nothing.
Hopefully in the future that'll pay off when they restart.
Yeah, they should be able to, and they have actually restarted a bit like M&S, a very, very miserly sort of dividend. But hopefully there's good scope for that to sort of to grow as management get more confident.
Another question's come in from David. Good question. What would you say are the key differences between Lowland and Law Debenture, which you also manage?
Yeah, so the number one thing that's different is that Law Deb has an independent operational business within it called the Independent Professional Services business.
Yes.
For Law Deb, that's 20% of their NAV, but roughly a third of the earnings of that trust come from what we call IPS, and it's independent services, nothing to do with me and James. It's an office down the road that run things like whistleblowing services, pension trustees, corporate secretarial services, corporate trust business, a load of independent business services that unusually sit with it. It's a very unusual structure that sit within an investment trust structure. So that creates a very different dynamic for Law Debenture, where you could think of it as almost having a 20% holding in IPS, this independent business, and then the rest of the equity portfolio, which is run by me and James, is effectively diversifying away from that IPS business. But that IPS business helps us in terms of the income. It gives us a third of the income every year straight up. And so we can run the portfolio with a lower dividend yield, knowing that the IPS is sat there generating roughly a third of the income. It's bigger as well. So it's bigger. It tends to have a higher weighting in the 100. It's roughly $1 billion in terms of market and rounding, whereas Lowland is more like 350. So Lowland tends to have more in smaller companies. So those are the, that's very high level. Those are the key differences. So bigger, has IPS, smaller, more domestic. Hopefully that's a very high level summary.
A lot of sense, and it's quite clear. So they're quite differentiated, and should appeal to investors with different objectives. Good, thank you. Couple of things that I was interested in asking about. First of all, do you use leverage, particularly as things seem so cheap at the moment? And what mechanisms do you use for leverage?
That's a good point, and I'll cover off Lord as well because they're similar. So both Lowland and Lord have 12-13% gearing, and that's pretty structural. Very occasionally it gets to, this before my time, pre-GFC, James took it right down to sort of net cash for both trusts, but obviously that was a very extreme situation, and at the moment we can see good value opportunities. So the gearing has been there or thereabouts for a while. Some of that is fixed term loans out quite a long way. So Lowland has a private placement that goes to, I think it's 2037, 2036, 2037, that's fixed at 3.15. So a good chunk of the borrowing is that. And then the rest is just an RCF, like 2-3 years. So it's a mixture of, and it's the same for Lord. It's a mixture of fixed and floating.
Thank you. And then Roy has another question.
Hopefully I'll be of more use for this one.
Well, no, that's all good stuff. Thank you. Is managing is there any risk of conflicts in managing multiple trusts?
Yeah, it's a good question. There is first thing to say, there's a fair degree of crossover at this. Where a company is relevant, it will tend to go in both trusts. So what do I mean by that? Something like Shaftsbury, it's gone in both. Something like that fits in both. Lord can have more by way of zero yielding or very low yielding shares for the reason that I was talking about, where you've got IPS and it gives you a third of the income. So Lord can hold more of, Lord has more of things like Rolls-Royce, where there is no yield, but we can do that because it has a slightly different way of contributing. There's a different way of delivering the same level of income, and we can hold more zero yielding. So we know, me and James, which portfolio, most of the time things can go in both, but if we're looking at something that has no yield, we know that it can be, can probably go in both, but it needs to be bigger, and it can be bigger in Lord and we can still deliver on the yield objective.
And you mentioned that Lowland has more of a small cap focus, so you're not really competing with Lord Venture on those sort of stocks.
Well, Lord we've just got to be cognizant of its size. It's a billion, roughly 800 million of that is the equity portfolio that we manage. So it's obviously you can't move in and out of smaller companies in the same way as Lowland is closer to 350 million. So you can be more flexible even at the smaller end. So Lord has about 50% in the 100, but it also has an overseas element, just to confuse things, whereas Lowland has more like 40% in the 100 today.
Thanks. And then just one more I wanted to ask myself. One company in the 250 that I like an awful lot. It wasn't in your top 20. I just wonder whether you hold it at all and what your thoughts on it were. And that's Cranswick, the food processor. I think they've had a phenomenal track record. Though they're not particularly cheap right now. They were last year, but
I agree with all of that, and we own it. In both Lowland and Lord and the open-ended fund that I do as well. Great company, really like Cranswick, really solid management team. So it's like very briefly, because some people might not know it, pork and poultry processor, not the most glamorous. I always turn down a site visit. I know I shouldn't, but I just couldn't bear it. But they've done very well in pork. Now moving into chicken, they know exactly what they're doing. They're taking on people that are what's the word? What's the one? Is it called Two Sisters? There's a competing brand in chicken that's very badly invested. It's got a ton of debt. Just leads a path for Cranswick to take share. It's exactly that type of business that we like. Domestic market leader, but no one's ever heard of it. It's not a household name, and grown well, good returns, solid balance sheet. Yeah, I like it a lot. I agree with you that it's not super cheap right now. And I have been debating whether we should.
Quite nicely, which is nice for our portfolios, but not so good if you want to buy it.
Yeah, it's I would describe it as sort of a hold, possible profit taking. We haven't done anything yet, but sort of debating it now.
Great. Well, I think that's covered all the questions that came in. So thanks very much for your time and the answers,
Okay.
Laura. Most interesting to hear about Lowland. Thank you.
Thank you.